Hello everyone, and welcome to the last webinar for 2015. I'm sure most of you will agree that 2015 has been a tumultuous year around the world, regardless of where you're at and what sector you're involved in. What we're going to be looking at in today's webinar is what you can look forward to with respect to IFRS in the coming year and beyond that, as well as what new standards are currently under development and will be issued hopefully in the coming months. We'll start off our discussion today with an overview of the standards that will be coming into effect in 2016 itself, or more specifically for years beginning on or after 1st of January 2016. Now, the topics we'll be looking at in this section, in most cases, will have resulted from amendments that were issued as far back as 2013 in some cases, but because of the practice of the IASB to have a phased-in approach and to allow a period of time before new pronouncements become effective, they do now become effective for the first time for this period. And as I indicated, most of them would have then the starting point of 1st of January 2016. The first topic in the newly effective standards arises from amendments to IAS 16 on property, plants and equipment and IAS 41 which deals with agriculture or the accounting related to agriculture. Now, the background to the agricultural standard for quite some time now is that a biological asset in the scope of IAS 41, which includes both living plants and living animals, would be accounted for at fair value on a continuous basis for as long as that asset is in the biological process. And then at the point of harvest, any agricultural produce is also measured at fair value less cost to sell, which would then become the measurement point for the subsequent measurement of that agricultural produce as inventory. Where this becomes relevant, particularly for those entities that are involved in the agricultural sector, is around the so-called bearer plants, and this relates specifically to a plant that will be used in an agricultural process in the production or supply of agricultural produce, a plant that is expected to bear produce for more than one period and also has a remote likelihood of being sold as agricultural produce except as scrap. So for example, if one looks at the balance sheet of an apple farmer, the apple trees themselves would presumably meet the definition of a living plant in that an apple tree would meet all of these criteria. It's something that is held to get to the point where it becomes fruit bearing, and then at the moment the plant is now fruit bearing, it then will bear fruit, which basically means that economically it's no different to a machine that is used in a manufacturing process to manufacture goods for sale. As a result of the amendments to IAS 41, a bearer plant is now within the scope of IAS 16, and the result of that is that bearer plants will be accounted for as property, plants and equipment. The accounting for bearer plants under IAS 16 will be exactly the same as any other piece of property, plants and equipment, whether that's manufacturing plant, furniture and fittings, computer equipment and the rest. And what that means is that both the cost and the revaluation model will be available, and by implication then the normal rules for accounting for property, plants and equipment, including things such as depreciation, componentization presumably, reviews of useful lives, etc. All of the accounting implications of property, plants and equipment will now be applicable to bearer plants. It's important to note that this amendment, however, only applies to plants. It does not apply to animals that might also be bearer animals. So for example, livestock that is held for breeding purposes, one could argue is also of a bearer type asset, are not within the scope of the amendment, and such animals will still continue to be accounted for under IAS 41. Moving on to group accounting. The next topic deals specifically with amendments to separate financial statements. Now, for background purposes, separate financial statements apply specifically to the financial statements in which a parent of a subsidiary presents its investments in subsidiaries, associates and joint ventures at an alternative measurement, using an alternative measurement basis as opposed to consolidation or equity accounting, which would be applied in the consolidated financial statements. Historically, in separate financial statements, an entity would choose to use either the cost model or the fair value model, depending on an accounting policy election. And as a result of a recent amendment to IAS 27, which now comes into effect for the first time in 2016, there is now a third alternative. In the separate financial statements, an entity can also opt to use equity accounting for such investments. What's important to note about this development is that the accounting policy option is applicable to an entire category of investments. So for example, an investor that has subsidiaries, associates, and joint ventures could have, for example, subsidiaries at cost, joint ventures at fair value, and could opt to apply equity accounting to its associates. It cannot choose to have one subsidiary at cost, one subsidiary at fair value, and another subsidiary at using equity accounting. It's applicable to an entire category of investments. How widespread this amendment will be, will have effect depends on the circumstances, and it would probably only really be of significance to those entities that have subsidiaries, given that equity accounting would be applied to associates and joint ventures anyway. So why an entity would opt to then also apply equity accounting to those categories of investments in the separate financial statements would depend on the circumstances of that particular entity. Once again, this amendment comes into effect from 1st of January 2016. The next amendment relates to the first of a series of amendments that we are waiting for out of the new broad project relating to the Disclosure Initiative, which I will talk a little bit more in detail about later on in this webinar. But towards the end of 2014, the IASB amended IAS 1 to provide a little bit more clarity around the presentation of financial statements with an aim to try and improve the quality of disclosures given the types of disclosures that had been seen to date. Very briefly, the Disclosure Initiative is trying to improve disclosure across the suite of IFRSs, and you'll see when we get to the work plan and what standards are currently under development, there are a host of additional amendments that are on the horizon. But in the meantime, the first round of amendments deals specifically with 4 broad areas around IAS 1 in principle. IAS 1 obviously sets the parameters for any set of financial statements that are developed under IFRS. It does not deal specifically with individual transactions, but more around the principles around the preparation of financial statements. What's of interest is that the IASB targeted the issue of materiality with the first stab at dealing with this. There is currently another project on the agenda dealing specifically with a practice statement to provide clarity and guidance on what materiality means. The amendment that we're looking at the moment here, however, the amendment to IAS 1, is around the materiality in the context of disclosures. So what this amendment basically says is that disclosures in financial statements should only be provided if the effect of providing those disclosures is material. Now, it's worth noting that the IASB has not amended the definition of materiality here. Something is material if its omission or misstatement would be expected to affect the decisions taken by the users who have relied on those financial statements. So that definition's been with us for many years, and nothing's changed with respect to the definition of materiality. However, the IASB acknowledged and reminded us again that materiality must be assessed both by nature as well as by amount. So we've referred to both qualitative and quantitative materiality. And in this context, we would then also have to consider the qualitative aspects of disclosures in deciding whether something is material from the perspective of the financial statements. So in making this assessment, the IASB has reiterated the fact that, and this applies in general across the board, in fact, in any IFRS, one would only be required to provide or comply with the requirements of the standard if doing so would be material. But in relating to the specific amendment, the IASB has said that disclosures of IFRSs must only be provided where the effect of doing so would be material. It has reiterated the fact that preparers must provide whatever other information is required in terms of disclosures, regardless of whether a standard specifically requires this disclosure or not. But these disclosures must be provided if the users would benefit from the inclusion of additional disclosures that might not have been specifically requested by various standards. And then the amendment also addressed the issue of aggregation. What the issue relates to very briefly is that preparers must aggregate all transactions that have a similar nature and must disaggregate transactions that have different natures. However, if a particular transaction or item has a different nature and it is not material, then it can be aggregated with other line items, for example. So if one looks at the balance sheet, you've got certain line items that have traditionally been separately disclosable. And if the effect of this amendment is basically saying that if you've got a particular disclosable line item and that line item is not material, well, then you can just aggregate that with another batch of line items, provided you are not obscuring material information by doing so. So there's that proviso just to limit the possible unanticipated consequence of moving in the opposite direction of providing too little information. And the amendments make it very clear that you may not use aggregation as a way of concealing or obscuring material information. The amendments also address the issue of minimum line items, moving on to the second point on the slide. And once again, this is drawing materiality to the fore and saying, you know, even though there might be specific mandatory disclosures, shopping list of disclosures in various standards, and very often these might be described as at a minimum the following shall be disclosed for various transactions. Once again, materiality should be the overriding constraint over here, and if the effect of a particular mandatory minimum line item disclosure is not expected to be material, then an entity need not comply with the requirements. The standard was also amended to specify or to address the issue of other comprehensive income. Some years ago, IS1 was amended as part of a round of improvements projects to require a split in the presentation of other comprehensive income. Essentially, the other comprehensive income section of the statement of profit or loss and other comprehensive income needs to differentiate between items of OCI that will be reclassified subsequently to profit or loss and those items of OCI that will never have a profit or loss impact in future periods. So for example, when one goes to the various standards which require certain gains or losses to be recognized outside of profit or loss into other comprehensive income, the standard that requires this treatment will specifically say whether something must then subsequently be reclassified into profit or loss or not. So for example, revaluation adjustments in respect of property, plant and equipment, IAS 16 specifically tells us that those are not reclassified subsequently even when the gain is realized, whereas available for sale revaluations under IAS 39 effectively are deferred in other comprehensive income until the underlying investment is sold, at which point the realized gain is then reclassified into profit or loss out of the available for sale reserve through other comprehensive income. The issue of OCI and the split between the reclassified and not reclassified, as I say, happened some time ago, but the IASB perhaps forgot about the issue around the treatment of associates or equity accounted other comprehensive income. And so this amendment to IS1 basically confirms that when one equity accounts an investment in an associate or an investment in a joint venture, the process of equity accounting requires you to recognize the investor's share of other comprehensive income movements, and those shares of OCI movements as a result of equity accounting must also be split between OCI to be reclassified and OCI that will not be. So it's just to conform or to bring in consistency with the earlier amendment that was made a couple of years back. And then the last issue that the IASB addressed as a result of the disclosure initiative, the first round of disclosure initiative topics, was the issue of notes. And what this deals with is the requirements of notes are that basically it provides clarification that there is no set structure around how the notes need to be provided. There's been a tendency in recent years that there's some kind of a perceived order of presentation, and that's largely driven as well by the use of templates. Primarily the most popular templates, users of those templates might believe that the layout or structure of a particular template is the required treatment in terms of the standards. And what this amendment basically confirms is that there is no such set structure. The decision around how the notes need to be structured and laid out is a preparer decision that's made, and the principle that needs to be applied over here is that one would use whatever's most suitable for their particular circumstances, what is most relevant for the users of that particular entity's financial statements. The effect of this will largely depend on how an entity, how a preparer of financial statements wants to try and provide the most useful information to the users of these financial statements. In making this approach, or rather in making this change, in restructuring the layout of the notes, one could consider alternatives such as perhaps grouping together notes on the basis of similar measurement models. So for example, group all the notes that relate to fair value items together, which then means that one can address the issues around the IFRS 13 disclosures in a more efficient manner. Alternatively, one could reorder the notes so that the most relevant notes are presented first, and then the notes that aren't that important to that particular entity are left for the end. In doing so, then one would presume that for a manufacturing company, the property, plants, and equipment notes would be front and center together with inventory and other issues that are more relevant to there, whereas in a financial institution, the first few notes would probably focus more on the financial instrument disclosures of IFRS 7. Another alternative that could also be quite useful and in fact encouraged if entities are keen to try and improve the layout of their financial statements would be to actually group everything to do with a particular line item in a single note. And where some entities have now taken the initiative on this, for example, if one goes to a line item on the balance sheet, property, plants, and equipment, and the corresponding note cross-reference, one could then go to that note and find everything to do with that particular line item, including accounting policies, significant judgments, as well as the numerical reconciliations and breakdowns of the balance, all contained within a single note, which then avoids having to have users paging, to different sections where the accounting policies are up front, and then the actual detail of the notes is later on in the financial statements. But these are all just recommendations. What's clear from the amendment is that each entity is required to use its judgment to decide what is the most appropriate layout for the notes for its particular circumstances. And then lastly, on this topic before we move on, the final issue around the notes is that the wording in the standard has removed previously the standard said an entity must disclose a summary of significant accounting policies. The words "a summary" have been deleted by these amendments. What the implication of this is that when one provides accounting policies as part of the notes to the financial statements, only the significant accounting policies need be addressed. One does not need an accounting policy for literally every single line item in the financial statements. But then out of the significant accounting policies that are disclosed, one should now try and avoid generic abbreviated disclosures that just summarize the key principles and rather focus on the detailed application of how those significant accounting policies have been applied to the particular circumstance of the entity. So on the whole, the disclosure initiative amendments are likely to improve on the quality of disclosures as the first round of amendments out of the disclosure initiative, and hopefully going forward we will see better quality disclosures emerging out of this. And once again, 1st of January 2016 is the effective date of these amendments. We also have a round of annual improvements projects that kick in from the 1st of January of 2016. The improvement cycle in particular is the 2012 to 2014 cycle. And in this round of improvements projects, we had 4 amendments to standards, or 4 standards were amended. Specifically, the amendments to the standards deal with amendments to IFRS 5. The amendments in IFRS 5 deal with the issue where an entity that might have had a non-current asset or disposal group classified as held for sale that has now been reclassified, or rather the change in manner of disposal has now changed from being for sale to distribution to owners, for example. So it's a change in the manner of disposal or distribution, and what the implication of such a change would be. And basically what the amendment under the improvement project said is that this is acceptable. It does not result in a change in classification. One would continue to classify such an investment as held for sale or held for distribution with everything that IFRS 5 requires for this, this designation. However, the change in intention does not reset the clock on the 12-month limit for such a classification. So in effect, what we're saying is, in order to have something classified as held for sale and the accounting and presentation that goes with such a classification, IFRS 5 requires the sale or distribution to be within a 12-month period. If during the 12-month period the entity now decides to distribute instead of sell, the clock does not restart, and that distribution must still occur within the 12-month period from the initial reclassification. The amendments to IFRS 7 relate to the disclosures of financial instruments. In this case, there were actually 2 amendments relating to IFRS 7 as part of the improvements project. Minor amendments in and of themselves, but still worth noting. Firstly, the first relates to the issue of transfers of financial assets where there might still be continuing involvement. Basically, in short, what this relates to is where a financial asset is transferred to another entity, perhaps as part of a factoring arrangement or some other type of arrangement in which the entity wants to de-recognize the instrument. If there is still continuing involvement, there is additional disclosure that IFRS 7 requires in respect to the balances, the risks that the entity is still exposed to, and any possible liabilities that might have been assumed as a result of this. The amendment in particular relates specifically to a servicing contract, and this clarifies that a servicing contract would presumably then fall within the parameters of a transferred asset, but it sets out the parameters in which this would be the case. So depending on the terms of such a servicing contract, that could be deemed as continuing involvement, which would trigger the additional disclosure requirements for assets that have been transferred but do not qualify for derecognition. The amendments to IAS 19 deal specifically around defined benefit plans and the measurement thereof. Very briefly there, a defined benefit plan is measured through a combination of different measurements, but part of those measurements requires present valuing of the defined benefit obligation as well as any plan assets that might, as part of the fair valuing, there could also be some present value calculations to measure the obligation and assets relating to the defined benefit plan. The amendment targets the measurement aspects of the present value calculation, specifically what discount rate to use, and the issue relates now to a regional market issue, and the amendment clarifies that the discount rate that should be used, IAS 19 requires high quality corporate bond rates to be used for estimating the discount rate for the post-employment benefit plan. That discount rate should be denominated in the same currency as the benefits to be paid out, and this provides clearer guidance then as to how to go about measuring these types of benefit plans. The last amendment in the improvement cycle relates specifically to interim financial reporting, and all that basically says is that when an entity is providing interim information, condensed information as part of its interim financial reporting, many of the requirements of IAS 34 can be provided in some form of management commentary that falls outside of the condensed financial statements themselves. However, that financial information must be presented, or that management commentary must be as part of the interim report itself. So one can't cross-reference information to something completely different, and there must be clear cross-referencing within the interim report to this information that's contained in other management commentary to allow users to easily find the necessary information. All four of these amendments kick in for periods beginning on or after 1st of January 2016. Our next amendment relates to the accounting for acquisitions of interests in joint ventures. To give you some background to this project, the IASB amended, IFRS 11 replaced IAS 31 some time ago. It actually came into effect from the 1st of January 2013. The amendment in particular that is now coming into effect for the first time was itself issued in May 2014. Very briefly, in terms of IFRS 11, there are two types of joint arrangements. One can either have a joint operation or a joint venture. A joint operation is an arrangement where the parties that share control of the arrangement have rights to the assets and obligations for the liabilities themselves. In contrast, in a joint venture, the venture itself has assets and liabilities. The parties that share control of the arrangement have rights to the net assets of the arrangement. Now, there are issues around determining whether an arrangement is a joint operation or a joint venture, but we're not going to be focusing on that at the moment. In terms of the accounting, once one has determined that you have a joint venture or a joint operation, in a joint venture you apply equity accounting to the investment if you are the venturer. Proportion consolidation, which was allowed under the old IAS 31, is no longer permitted. You have to apply equity accounting to such an investment if you have a joint venture. With a joint operation, because the operator has rights to the assets and obligations for the liabilities, the accounting is reflected in a similar manner. So the operator accounts for its share of any assets held jointly, its share of any liabilities incurred jointly, its share of revenue and its share of expenses, with an elimination of its share of any transactions with the joint operation. The amendment in question that we're looking at now deals specifically with an acquisition of an interest in a joint operation. If one is acquiring an interest in a joint venture, there aren't really any issues around the accounting, because one would simply add on, as part of the equity accounting, an additional portion of that, or an additional portion of the underlying investment's equity will be added to the investment in the venturer's financial statements. But from the perspective of an operator, when one's dealing with a joint operation and one acquires a stake in an existing joint operation, one needs, well, up until now, there's been a bit of a conundrum as to what type of accounting to apply. Given that you're accounting for these little bits and pieces, how would one then allocate the acquisition or the purchase price of all of these bits and pieces to the financial statements of the joint operator? So the amendment in 2014 basically confirmed that in dealing with such a situation, if the operation in question, if the interest in the joint operation meets the definition of a business, the acquirer must apply IFRS 3. IFRS 3 is the standard on business combinations, and in essence what we're saying is we will apply business combination accounting to such a transaction. The treatment that I've just described over here is applicable to both initial investments and additional interests acquired in the joint operation. However, it only applies if the joint operation meets the definition of a business. If it is not a business, or for example, if the joint operation is established by the investors only contributing assets, then IFRS 3 accounting does not apply. The amendment also does not apply to a transaction under common control. Currently under IFRS 3, for an outright acquisition of a business combination in general, common control transactions are scoped out, and the same principle applies to the scenario where such a common control transaction might involve a joint operation. So everything around this amendment focuses on whether or not the acquisition or the operation meets the definition of a business. Just for the purposes of clarity to those listening, a business is an integrated group of assets and activities that includes inputs that work together with processes to generate outputs. If you don't meet the definition of a business, then this does not apply, and you will have to come up with some other method of accounting for such a transaction. If you do have a business, then the IFRS 3 process is identical to an outright acquisition of control for a business combination. The only difference in business combination accounting in this context is that, unlike business combination accounting under IFRS 3 for subsidiaries, one disregards non-controlling interest, and the reason for that is because the assets and liabilities that are recognized in this process is only for the investor's share of the assets and liabilities. With full business combination accounting, the acquirer recognizes 100% of the assets and liabilities and then removes the portion of the equity that is attributable to non-controlling interest. Because we are only recognizing our share of the assets and liabilities of the acquired business, then there's no need to recognize non-controlling interest because we have only brought in our share of that. This amendment is also applicable 1st of January 2016, although to be honest, I would imagine anybody that has had such a transaction would probably have early adopted this, given that there is no real other way of accounting for such a transaction other than doing what this amendment requires. The next amendment deals with amendments to IAS 16 and IAS 38, related amendments. They actually are very similar, although the one relates to property, plants and equipment, and the other relates to intangible assets. Basically, this deals with clarification around what would be considered acceptable methods of depreciation and amortization. But there's also a side amendment that is brought to mind as well. So firstly, IAS 16 was amended to say that where there is an expected future reduction in the selling price of an item that was produced using an asset, that could indicate the expectation of technical or commercial obsolescence of the asset, which in turn might reflect the reduction of the future economic benefits embodied in the asset. Now, an expected future reduction in the selling price of an item would probably be an indicator of impairment. Not probably, it would most definitely trigger an impairment test under IAS 36. What the effect of this amendment is basically saying is that if you do have a trigger of impairment relating to something like the selling price of an item that is the output of the property, plants and equipment, that will probably have an impact on the depreciation, and one would have to argue very strongly why such an impairment event would not have a consequential impact on the consideration of the depreciation method, useful life, and possibly even the residual value of such an asset. So basically what this amendment is doing is it is drawing a closer link between the impairment issue, which is a valuation issue, and the depreciation issue under IAS 16, which is a cost allocation issue, and saying that one cannot treat the one in isolation of the other. A further amendment to IAS 16 is to confirm that it would be inappropriate to have a depreciation method based on revenue as opposed to consumption of the economic benefits of the asset. Apparently what had happened around the world is some entities had been depreciating their property, plant and equipment on the basis of when the inventory that is manufactured by the property, plant and equipment is eventually sold. I must be honest, I'm not quite sure how the accounting for that would probably have worked, because it does seem like a very odd method of depreciation. But nonetheless, this amendment has confirmed that such a treatment is not acceptable under IAS 16. And that basically means that your depreciation method must be based on the consumption of the benefits in the context of a piece of manufacturing plant. That means that when the item is produced, you would be depreciating the asset, not when the item is sold. So it's a common sense approach, but it's now confirming that any alternative is not acceptable. The amendments to IAS 38 are very similar. We also have a similar amendment that confirms that a reduction in the selling price of an item used that was produced using an intangible asset could trigger an impact on the future economic benefits. So once again, drawing a parallel or a link rather between the impairment issue and the amortization of intangible assets. And similar to IAS 16, a further confirmation that you cannot have a revenue-based amortization method. It would be inappropriate to do so. However, there is a slight difference in the IAS 38 scenario in that this is a rebuttable presumption. So whereas IAS 16 categorically said you cannot have depreciation based on revenue, in the IAS 38 example, if the intangible asset is expressed as a measure of revenue, for example, if the intangible asset refers to a right or a license that is based on future sales, then that future economic benefit of that intangible asset is quite clearly aligned to the revenue that is generated, and under those circumstances there would be a very high correlation between the intangible asset and the revenue. So in the case of intangible assets, you can rebut that presumption. With investment entities, the amendments to investment entities, this is probably the most recent, well, this together with the IAS 1 amendment, the most recent amendments that come into effect from 1st of January 2016. This relates specifically to the circumstances in which an entity may be exempted from consolidating an entity an entity over which it has control. Just very briefly, the general rule of thumb says an entity that has control of another entity must consolidate that entity. That's been an overriding principle back in the IAS 27 days, and that flows through into IFRS 10, the replacement standard on consolidations. The only time an entity would be exempted from consolidation where it has control of another entity is if that parent itself is a subsidiary of another entity and all of the shareholders approve. The parent's debt or equity instruments must not be traded in a public market. It must not be in the process of issuing any class of instruments in a public market. And the entity's ultimate or intermediate parent produces IFRS compliant financial statements available for public use. So to apply this exemption to a practical scenario, if one looked at the following group structure, where you've got a vertical group with the ultimate parent, the intermediate parent, and the subsidiary, assuming that expectations in our scenario over here meets all four of the criteria that I've just specified. It is itself a subsidiary of another entity, and assuming the other shareholders agree. It is not listed, it's not in the process of obtaining a listing, and expectations itself will be consolidated higher up in the group. Expectations would qualify for the exemption. The exemption is voluntary. If it wanted to consolidate Prospect, it would be more than acceptable for it to do so. But it would not need to consolidate if it simply wanted to present separate financial statements, because it would be consolidated ultimately by great returns. When IFRS 10 was issued, that was the only exemption from consolidation. However, in 2014, IFRS 10 was amended to introduce the concept of an investment entity. An investment entity is basically an entity that obtains funds from one or more investors for the purpose of providing investors with investment management services. It commits to its investors that its business purpose is to invest funds solely for returns for capital appreciation, investment income, or both, and it measures and evaluates the performance of substantially all of its investments on a fair value basis. Now, such an entity there's limited circumstances where that would be the case. It's not free for all, but under those circumstances, if an entity was an investment entity, it would be required to measure any investments in subsidiaries at fair value through profit or loss, as opposed to consolidating them. So going back to our scenario, if one was to consider a similar group, with the only difference now being that instead of apologies for that, the ultimate parent right at the top being an investment entity, The question then would be, would expectations still qualify for the exemption, given that, based on the exemptions that we just spoke about, it would not be consolidated by Great Returns, rather Great Returns would fair value that investment in expectations. Now, prior to the amendment to IFRS 10 that we're looking at, presumably the exemption would not qualify. And as a result, expectations would have been required to consolidate Prospect, because there would be no IFRS consolidation at the ultimate level or at the top of the group. The amendment basically says, has amended that fourth criterion for exemption to read, apart from the fact that there would be a consolidation, if the subsidiaries would be measured at fair value to profit or loss in accordance with IFRS 10, presumably as a result of the investment entity's exception, then the exemption still applies. So applying it to our group scenario, we would then have expectations qualifying for the exemption provided the other three criteria are specified, even though it will be fair valued because of the expanded exemption from consolidation that is the subject of this amendment. The exemption also applies to investments in associates. So in expectations case, it would also not be required to equity account associate limited on the basis that it qualifies for the exemption from consolidation for Prospect Limited. As part of this amendment, there's also a further amendment around the treatment of equity accounting and investment in an investment in an associate that is an investment entity. So to explain the scenario over here, in the group structure that you see in the slide in front of you, Expectations Limited would be fair value in Prospect because it is an investment entity. Great Returns would have to equity account its associate Expectations. The question that arose is, because IAS 28 requires equity accounting to be applied using the investor's accounting policies, from Great Returns perspective, it is not an investment entity, and therefore presumably Great Returns would have to equity account expectations on the consolidated basis where Prospect has been consolidated into expectations. The amendment to IAS 28, however, now confirms that the fair value accounting that applies to the investment entity level does flow through if the ultimate investor has to equity account. So going back to our scenario, in the scenario in front of us, we would have a situation where expectations would fair value Prospect and Great Returns would equity account expectations, with Prospect having been fair valued there. Lastly, as part of this batch of amendments to the group accounting standards, IFRS 12 has been amended to confirm that an investment entity must provide the IFRS 12 disclosures even though it has not consolidated any subsidiaries. Any disclosure requirements of IFRS 12 will need to be applied by that investment entity. So that's the overview of the standards that become effective in the 2016 calendar year, or rather for years beginning on or after 1st of January 2016. If an entity has a December year end, that means that without a doubt all of these amendments that I've just gone through will have to be applied to the extent relevant in the December 2016 financial statements. But for those entities that have a year end other than December, those will have to be applied in the 2017 financial statements. For the remainder of this webinar, I'd just like to take a few moments to talk about what is on the horizon. At the present moment, there are a number of standards that have been issued but are not yet effective. And two of them are relatively major standards. Not relatively, they are quite very much so, major standards. The first of the two standards is IFRS 15, which deals with revenue from contracts with customers. And basically what this standard does is it replaces the existing revenue standards, and there's a whole host of them. We've got the two standards themselves, IAS 18, which deals with revenue, IAS 11, which deals with construction contracts, and then a whole host of different interpretations that deal with both of those standards, being replaced by a single revenue standard that basically applies the same revenue recognition model to all transactions, regardless of whether it's a construction contract, whether it's a telecommunications company or a simple retailer. every transaction will be accounted for, or rather the revenue for every transaction will be accounted for using this 5-step revenue recognition model. We do have a detailed webinar on IFRS 15, so if you have not yet had a chance to listen in on that, please do yourselves a favor and try and get hold of that through the launcher, because it is definitely a standard that is going to have a very wide impact on every entity that reports in terms of IFRS. Now, IFRS 15, when it was first issued, had an effective date of 1 January 2017. A recent amendment to IFRS 15 has extended that effective date to 1st of January 2018, which gives us a bit of breathing space, but bearing in mind that the transition to the new standard will be retrospective. There are some alternatives on transition, but for the most part there will be retrospective accounting required to some degree, and that means that there's little over a year before one needs to start planning for the for the transition to IFRS 15. So our advice to everybody that is listening is to use the year ahead to start planning for the transition to IFRS 15, because when it comes, it will have an impact on pretty much everybody. The other big standard that could have an impact is IFRS 9, dealing with financial instruments. IFRS 9 is a standard that has been developed in phases over a number of years. Each phase dealt with a different aspect of financial instrument accounting, primarily around classification and measurement, impairment of financial assets, and the rules around hedge accounting. Now, once again, we do have detailed webinars on these different aspects. So again, I encourage listeners to try and listen in on those if you can. But very briefly, classification of financial instruments is now going to be a lot less rules-driven and more aligned to the business model of the entity. Impairment of financial assets is going to focus on the expectation of future losses rather than waiting for a loss event to have been triggered as a result of objective evidence of impairment, which is what's currently required under IAS 39. And hedge accounting is going to become a lot less onerous, not so much around the accounting entries that would be applied for hedge accounting. In fact, that it remains exactly the same as what was required under IAS 39, but rather the rules for qualifying for hedge accounting, rules such as hedge effectiveness and retrospective testing and so on and so forth, become a lot more relaxed rather, and less onerous to apply. So there as well, aligning the principles of hedge accounting with an entity's risk management activities rather than simply arbitrary rules that might have no relation to how the risks are actually being managed. IFRS 9 is also a standard that could have a major impact depending on the circumstances of a particular entity. This standard is also effective for years beginning on or after 1st of January 2018, which is now exactly the same effective date as IFRS 15. Once again, we would encourage entities to use the coming years wisely to plan for the transition to the standard. As with IFRS 15, there will be a retrospective application, and therefore, one needs to understand what impact the new standard might have and how to start planning for that. For those that are interested, there is also another amendment or another batch of amendments to IFRS, specifically the revised IFRS for SMEs. This is only applicable to SMEs, but I know there are some of you that dabble in both full IFRS and IFRS for SMEs, and so it's worth mentioning that the revised standard has been issued. It was issued in May 2015. It is the first time the SME standard has been revised since its original issue back in 2009. And effectively, there have been over 56 different amendments to the standard. Some of them relatively minor, some of them a little bit more significant. In essence, we now see the introduction of additional accounting policies, or rather choices around accounting policies. There have been some changes and clarifications to current requirements and the introduction of additional undue cost or effort exemptions. And there has been some alignment to reflect recent changes to IFRSs, although the IASB did say that they were not going to be trying to track changes to full IFRS on a line-by-line basis. In essence, the new financial instrument standard and the new revenue standard will not affect SMEs at present, and it is and the forthcoming leases standard IFRS 16 will also not be applicable to SMEs. And there's a whole host of other amendments over recent years, for example, the new consolidation standards, the new joint arrangement standards, IFRS 13 on fair value measurements. None of those have been incorporated into the IFRS for SMEs. So on the whole, the IASB have tried to make the IFRS for SMEs that much easier for entities to apply, but it still remains, well, and the gap between full IFRS and IFRS for SMEs grows ever wider, with the point that at some point it's quite possible that they will be seen as completely different, or not to say that they are, that the one depends on the other, but increasingly we are seeing them as becoming completely different frameworks and possibly even disciplines going into the future. For the last couple of minutes, I'd just like to take a moment to tell you a little bit about the IASB's work plan and what's to come. The major projects on the IASB's agenda as at the end of November of 2015 reflect the remaining big ticket items, the insurance contract standard and leases standards that are currently under development. Both of these have been on the IASB's work plan for a number of years. Both of them have gone through at least 2 exposure drafts and numerous consultation papers and discussion papers and so on. The insurance contract project will ultimately replace the existing IFRS 4 with more concrete principles around how to apply the accounting for issues that primarily affect insurance contracts, things like how to measure insurance risk, insurance liabilities rather, how to deal with the different aspects around insurance risk and the assets that relate to those activities. There's no chance that the insurance contract will be finalized before the end of 2015, but we are expecting, hopefully, during the course of 2016, a final standard, a final pronouncement in that regard. With leases, we are expecting a final standard before the end of 2015. In fact, the IASB have indicated unofficially that we expect what will probably be IFRS 16 within the last week or 2 weeks of 2015. So imminently, we're expecting the final standard. Once again, this standard is also gone through numerous iterations and changes, and at the present moment, we are expecting the final standard to do away with the existing dual lease model between operating leases and finance leases. And from the perspective of the lessee, specifically, a lessee going forward will recognize the right of use of the leased asset on the balance sheet as an intangible asset with a corresponding liability to pay for that right of use. Now, the accounting for that will be quite interesting to see how that emergence and what the impact will be on entities, but that is a completely different methodology as compared to what is currently required. We would expect, obviously it all depends on what emerges when the final pronouncement comes out, but we would probably expect an effective date of around 2019 for that, given that it's already at the tail end of 2015 and it's a major change, so the IASB would probably need to give preparers a long enough lead time to get to grips with the requirements. The other projects on the other major projects, you'll notice there a whole host of different disclosure initiative projects, and as I indicated at the start of this webinar, this is now going to be the focus of the IASB going forward, is to try and improve on the quality of disclosure. So already we've seen exposure drafts being issued in respect of the materiality practice statement and proposals for explaining what materiality means in different contexts and how one needs to apply this concept. As a practice statement, it's unlikely to be a standard, or rather a mandatory guidance as one would expect from a standard or an interpretation, but it would certainly be very useful information and guidance for those entities that have struggled with the concept of materiality in applying the requirements of IFRSs. There are other projects on the go, the conceptual framework, but it's in the deliberation stage. At this point, the IASB haven't decided on the project direction, so we aren't expecting any fireworks, at least not with an immediate impact on IFRS in the coming months. And around macro hedging and rate regulated activities, these are now more specialized areas of accounting, and the IASB is now going to, hopefully once they finalize their issues on insurance contracts and leases, can now start focusing their attention on these projects which have been on the to-do list for a number of years. And on top of this, there are also a host of other narrow scope issues, implementation issues. There are a batch of improvements projects underway, interpretations, and targeted amendments that will hopefully improve IFRSs across the board. So going into 2016, ladies and gentlemen, I'd like to thank you all for listening in on our webinars. Those clients that have been with us and supported us during the year, thank you very much for your support. And stay tuned in the coming months. We will be with you every step of the way as new standards get issued, as new developments occur, and this will be your one-stop shop for keeping up to date with the latest IFRS changes. From my side, I wish you everything of the best for the year to come. Thank you very much. Bye-bye.